The intelligence trap. There is a dangerous assumption that runs silently through modern finance. The smarter you are, the better your financial decisions will be. It sounds obvious. High IQ, strong analytical skills, elite education, data literacy, professional experience. Surely that combination should produce superior investing outcomes. And yet, it often does not. Some of the most educated investors panic at market bottoms. Some of the most sophisticated analysts chase bubbles. Some of the most credentialed professionals underperform simple index funds. Why? Because intelligence does not eliminate bias. In many cases, it amplifies it. This is where the work of Daniel Kahneman becomes essential. Kahneman did not win the Nobel Prize in economics for discovering a new financial formula. He won it for something more unsettling. He proved that human beings are not rational decision makers, not occasionally irrational, systematically irrational, predictably irrational. And intelligence does not immunize us from these patterns. The myth of the rational investor. For decades, classical economics assumed that markets were populated by rational agents, individuals who process information objectively, update beliefs logically, maximize expected utility, act consistently. But real-world behavior tells a different story. We buy high and sell low. We hold losers too long and sell winners too soon. We overtrade. We overestimate our skill. We underestimate risk. And we do all of this while believing we are being logical. Kahneman exposed the illusion at the heart of financial confidence. We think we are thinking clearly. Most of the time, we are not. The two minds inside every investor. Kahneman introduced one of the most influential frameworks in behavioral science, System 1 and System 2. System 1 is fast, intuitive, emotional, automatic. System 2 is slow, deliberate, analytical, effortful. Markets trigger. System 1. Volatility, breaking news, red screens, green rallies, narratives of fear and euphoria. Even highly intelligent individuals revert to fast thinking under stress. Intelligence does not switch off emotion. It often just rationalizes it. Why smart people are especially vulnerable. Here is the uncomfortable truth. Highly intelligent individuals are often more confident in their reasoning. Confidence feels like competence. But the two are not the same. Smart investors can build complex narratives around weak signals, justify risky positions with sophisticated models, overestimate the predictive power of their analysis, ignore base rates in favor of compelling stories. In other words, the smarter the mind, the better it becomes at defending its own errors. Kahneman called this overconfidence one of the most persistent and damaging biases in finance. Experts consistently overestimate the accuracy of their forecasts. Professionals trade more. And studies repeatedly show the more active the investor, the lower the returns. Intelligence often increases activity. Activity often decreases performance. The illusion of control. Markets are complex adaptive systems. They are influenced by global macroeconomic forces, human psychology, policy shifts, black swan events, technological disruption. Yet investors frequently behave as if outcomes are controllable. Forecasting becomes an illusion of mastery. Smart people are particularly susceptible to this illusion because they are trained to solve problems. But markets are not equations waiting to be solved. They are environments to be survived. Kahneman's research shows that humans systematically underestimate uncertainty. And the more knowledge we accumulate, the stronger the illusion becomes. The asymmetry of loss. One of Kahneman's most powerful findings was loss aversion. Losses hurt roughly twice as much as equivalent gains feel good. This emotional asymmetry drives irrational behavior. We hold losing stocks to avoid realizing pain. We sell winners too early to lock in pleasure. We avoid investing during downturns because fear dominates logic. Even when intellectually aware of long-term probabilities, the emotional brain overrides statistical reasoning. Smart investors are not immune. They simply build more elaborate explanations for their reactions. The narrative trap. Human beings are storytelling machines. We crave coherent explanations. When markets move, we search for reasons. When portfolios decline, we seek narratives. Kahneman warned against the narrative fallacy. We prefer stories over statistics. Smart individuals are particularly good at constructing compelling stories. But compelling stories are not predictive tools. They create the illusion of understanding. And that illusion breeds risk. The central question. If intelligence cannot protect us, if expertise does not eliminate bias, if analytical skill can amplify overconfidence, then what actually creates financial resilience? The answer is not higher IQ. It is architectural thinking. It is designing systems that reduce exposure to our own cognitive errors. It is recognizing that the mind is flawed and planning accordingly. This is the foundation of bias-resistant investing, what this episode will reveal. In this episode, we will explore why System 1 dominates under financial stress, how overconfidence silently erodes returns, why experts often fail at forecasting, how loss aversion reshapes portfolio decisions, why storytelling distorts risk perception, and how to build structures that compensate for cognitive blind spots. This is not a critique of intelligence. It is a recognition of its limits. The most dangerous investor is not the uninformed one. It is the highly intelligent one who believes he is immune to bias. Kahneman's legacy is not pessimism. It is clarity. We are predictable in our irrationality. And what is predictable can be managed. Intelligence can build models. But humility builds resilience. And in the markets, resilience compounds longer than brilliance. Welcome to the cognitive architecture of investing. Welcome to the mind behind the mistake. Welcome to Daniel Kahneman. Section 1. The Intelligence Illusion. There is a comforting belief among high achievers. If I understand the data, I will make better decisions. In finance, this belief becomes almost sacred. Elite universities produce brilliant analysts. Investment banks recruit top mathematicians. Hedge funds hire physicists and engineers. Financial models become increasingly sophisticated, and yet performance does not consistently improve with intelligence. In fact, the evidence suggests something unsettling. High intelligence often increases financial mistakes, not because smart people lack knowledge, but because they overestimate the power of their reasoning. This is the intelligence illusion. Intelligence versus rationality. One of Daniel Kahneman's most disruptive insights was this: intelligence and rationality are not the same thing. You can have a very high IQ and still fall prey to confirmation bias. Overestimate your forecasting ability, underestimate risk, hold contradictory beliefs, rationalize emotional decisions. Cognitive ability measures how well you process information. Rationality measures how well you avoid systematic errors in judgment. These are different domains, and markets punish the second more than they reward the first. The seduction of complexity. Smart people tend to prefer complexity. They trust models. They build frameworks. They construct elaborate theses. Complexity feels powerful. But markets often reward simplicity. Long-term diversified investing has historically outperformed many sophisticated active strategies. Why? Because complexity increases overconfidence, activity, transaction costs, exposure to noise, and intelligence fuels the desire to optimize. Optimization creates motion. Motion increases error. Overconfidence, the hidden multiplier. Kahneman identified overconfidence as one of the most persistent cognitive distortions in finance. The more knowledgeable individuals become, the more certain they feel about their predictions. But certainty does not equal accuracy. In multiple studies, experts performed only marginally better than chance when forecasting complex systems, and yet their confidence levels remained extremely high. This creates a dangerous pattern: high intelligence to high confidence to high activity to higher probability of error. In investing, activity often correlates negatively with returns. The illusion of skill leads to excessive trading. Excessive trading erodes capital. The illusion of explanatory depth. Smart investors often believe they understand complex systems deeply, but when asked to explain mechanisms step by step, the depth of understanding is often superficial. This is known as the illusion of explanatory depth. You think you understand how markets react to interest rate shifts. You think you understand geopolitical impact. You think you understand macro cycles. But markets are nonlinear systems influenced by countless interacting variables. The gap between perceived understanding and actual predictability is enormous. Intelligence widens that gap because it increases the ability to construct convincing explanations. Convincing explanations are not predictive tools. The confirmation bias amplifier. All humans seek information that confirms existing beliefs. But intelligent individuals are better at defending their positions. They can find supporting data more efficiently. They can reinterpret contradictory evidence more elegantly. They can build stronger narratives around weak signals. In short, intelligence does not remove confirmation bias. It strengthens its defense system. A less informed investor may hesitate. A highly informed investor may double down. Markets do not reward narrative consistency. They reward probabilistic humility. The expertise trap. Professional investors are particularly vulnerable to the intelligence illusion. Their careers depend on appearing competent. Competence is associated with conviction. Conviction increases confidence. Confidence increases activity, but markets reward disciplined inactivity more often than bold forecasting. Studies of professional fund managers show that many underperform passive benchmarks over long horizons. This does not mean they lack intelligence. It means intelligence does not neutralize psychological bias. Intelligence under stress. In calm environments, analytical thinking dominates. Under stress, the brain shifts. Volatility triggers emotional circuitry. Even highly trained individuals revert to fast, intuitive reactions when facing uncertainty. Market crashes activate fear of loss, urgency, social contagion, defensive action. Intelligence does not prevent this switch. It often simply justifies it after the fact. I sold because the macro outlook deteriorated. But often, the decision was emotional first, rationalized second, the social status factor. Smart individuals often tie identity to being right. Admitting uncertainty threatens that identity. In markets, uncertainty is constant. This creates internal tension. Instead of acknowledging uncertainty, the intelligent investor may increase analysis. Double down on conviction. Seek validation. Ignore disconfirming evidence. The need to protect intellectual identity can override probabilistic reasoning. Markets punish ego faster than ignorance. The core paradox. The paradox of intelligence in investing is this: the skills that help you succeed academically, analysis, modeling, argumentation, precision, are not the same skills that help you survive market uncertainty. Survival requires humility, simplicity, patience, risk control, acceptance of uncertainty. Intelligence can support these qualities, but it does not guarantee them. A necessary shift. Kahneman's work forces a difficult realization. Being smart does not mean being immune to bias. In fact, intelligence can make bias more dangerous because it hides behind sophistication. The solution is not less intelligence. It is structured skepticism toward your own reasoning. The most dangerous thought in investing is, I understand this. The more accurate statement is, I understand parts of this, but uncertainty remains. Closing reflection. The intelligence illusion convinces capable people that insight equals advantage. But markets do not reward insight alone. They reward disciplined exposure to uncertainty over time. They reward consistency over brilliance. They reward humility over conviction. In the next section, we will examine the machinery behind this illusion. System 1 and System 2, the dual engines of decision-making that govern every financial choice. Because to defeat the intelligence trap, you must first understand how your mind actually works. Section 2. System 1 versus System 2. The two minds inside every investor. If the intelligence illusion explains why smart people overestimate their judgment, System 1 and System 2 explain how the mistake happens. Daniel Kahneman's most influential contribution to modern psychology was not merely identifying bias, it was mapping the architecture of the mind itself. He proposed that our thinking operates through two interacting systems. System 1, fast, automatic, intuitive, emotional. System 2, slow, deliberate, analytical, effortful. Both are necessary. Both are powerful. Both shape every financial decision you make. But in markets, they do not operate equally. And under stress, one dominates. System 1, the automatic mind. System 1 is ancient. It evolved for survival. It reacts instantly to threats. It recognizes patterns. It jumps to conclusions. It fills in missing information. It operates effortlessly and continuously. When you see a red screen in the market and feel tension, that is System 1. When a stock surges and you feel excitement, that is System 1. When headlines scream crash or boom and you react emotionally, that is System 1. System 1 is fast. Speed is its strength. But speed sacrifices depth. System 2, the analytical mind. System 2 is slower and more deliberate. It performs calculations. It evaluates probabilities. It compares base rates. It questions assumptions. It requires effort. You feel its presence when solving a complex equation, reading financial statements, or building an asset allocation model. System 2 is capable of rational investment behavior, but it is lazy. Kahneman described it as a supervisor that prefers not to work unless forced. Most of the time, System 1 runs the show, and System 2 merely endorses its conclusions. Why markets trigger? System 1. Financial markets are designed to stimulate System 1. Volatility creates urgency. Price movements create pattern illusions. Media narratives amplify emotion. Social signals intensify reactions. Markets move quickly. System 2 does not. Under time pressure, uncertainty, or fear, the brain defaults to automatic processing. This is not weakness. It is evolutionary design. But evolution did not optimize the human brain for stock market investing. It optimized it for physical survival. The substitution trick. One of Kahneman's most powerful insights was attribute substitution. When faced with a difficult question, System 1 answers an easier one without telling you. Example. Difficult question. What is the long-term intrinsic value of this company? Easier substituted question. Does this story sound compelling? Difficult question. What is the statistical probability of recession? Easier substituted question. Do I feel worried? System 1 substitutes feelings for analysis. System 2 often fails to correct it. The intelligent investor believes he answered the hard question. He answered the easy one. The availability heuristic. System 1 judges probability based on what is easily recalled. If a market crash is recent and heavily covered in media, risk feels high. If markets have been rising steadily, risk feels low. But actual probability does not change according to media volume. System 1 equates vividness with likelihood. System 2 must intervene to apply base rates. But under emotional intensity, System 2 is often bypassed. The fluency illusion. Information that is easy to process feels more true. Clear narratives feel credible. Confident analysts feel accurate. A smooth presentation increases perceived validity. System 1 confuses fluency with truth. System 2 requires effort to challenge fluency. Smart investors often mistake persuasive explanations for statistical rigor. This is especially dangerous in finance, where storytelling drives sentiment. When System 2 fails, many assume that intelligent people rely more on System 2, but intelligence does not guarantee engagement. System 2 requires energy. Under fatigue, stress, or overload, it disengages. Markets generate constant noise. Earnings reports, macro announcements, political shifts, global crises. Continuous exposure drains cognitive resources. Once depleted, the brain defaults to System 1. Even professionals experience decision fatigue, and when fatigue rises, bias increases. Overconfidence in System 2. Paradoxically, System 2 can amplify bias. When System 1 forms a quick judgment, System 2 often constructs a justification. Instead of questioning intuition, it defends it. This is called motivated reasoning. The analytical mind becomes a lawyer rather than a judge. Intelligence strengthens this process. The smarter the individual, the better the defense. But a strong defense of a weak thesis remains weak. Loss aversion. Through the systems. Loss aversion is primarily driven by System 1. The emotional pain of losing triggers immediate defensive impulses. System 2 knows that markets fluctuate. System 2 understands long-term probabilities. But System 1 feels pain now. Under intense emotional activation, System 1 overrides long-term logic. This is why investors sell during downturns, despite knowing historically that markets recover. Knowledge is System 2. Fear is System 1. Fear moves faster. The illusion of prediction. Prediction feels analytical. Forecast models, spreadsheets, macro theses all appear to engage System 2, but prediction often begins with intuition. System 1 generates a directional belief. System 2 builds a framework around it. The investor experiences this as rational forecasting. In reality, intuition led, analysis followed. Kahneman repeatedly showed that experts' predictive accuracy in complex systems barely exceeds chance, yet confidence remains high. System 1 produces certainty. System 2 rarely dismantles it. How to strengthen System 2 in finance. Kahneman did not suggest eliminating System 1. That is impossible. Instead, the goal is structured correction. Ways to activate System 2 intentionally. Slowing down decisions. Writing investment theses before acting. Defining probabilities explicitly. Considering base rates. Seeking disconfirming evidence. Creating checklists. These mechanisms force System 2 engagement. But they must be structural, because relying on willpower alone reintroduces fragility. The crucial insight. The conflict between System 1 and System 2 explains a central paradox. Why intelligent investors behave irrationally in moments of stress. It is not a lack of knowledge. It is cognitive architecture. System 1 is fast, emotional, pattern-seeking. System 2 is slow, analytical, effortful. Markets are fast. Emotion is immediate. System 1 wins unless System 2 is deliberately activated. The humility principle. Understanding these systems changes the goal of investing. The goal is not to eliminate intuition. The goal is to design safeguards against it. The smartest investor is not the one who predicts best. It is the one who distrusts his own certainty. System 2 must not merely exist. It must be structurally engaged. And that requires architecture, not just awareness. In the next section, we examine one of the most dangerous consequences of this dynamic, overconfidence, and why expertise often increases financial risk instead of reducing it. Because the mind that thinks it sees clearly is often the one most blinded by its own conviction. Section 3. Overconfidence and the expert trap. If System 1 explains how bias emerges, overconfidence explains why it persists. Daniel Kahneman identified overconfidence not as a minor flaw, but as a structural distortion embedded in human cognition. And nowhere is it more dangerous than in finance. The paradox is unsettling. The more knowledge you accumulate, the more certain you feel. But certainty and accuracy are not correlated. In complex systems, like financial markets, they are often inversely related. The confidence illusion. Most investors believe their confidence reflects competence. If they feel sure, they assume they understand. But confidence is an emotional state. Accuracy is a statistical outcome. The two operate independently. Kahneman's research showed repeatedly that experts in forecasting, economists, analysts, strategists, displayed extremely high confidence in predictions that were barely more accurate than random guessing. Their intelligence did not eliminate error, it increased conviction. Why intelligence amplifies overconfidence. High intelligence strengthens pattern recognition. It allows rapid synthesis of information. It increases fluency in reasoning. But these strengths create vulnerability. When smart individuals form an intuition, they can support it with data. They can build elegant models. They can cite historical analogies. They can articulate compelling narratives. The conclusion feels reinforced. But reinforcement does not equal truth. Intelligence increases the ability to defend a position, not necessarily to validate it. The illusion of skill in random environments. Markets contain randomness. Short-term outcomes often result from noise rather than skill, but humans struggle to distinguish skill from luck. When investors experience early success, confidence rises. Success feels earned. The narrative becomes, "I saw something others missed." But in many cases, early gains are statistical variance. Overconfidence begins here. Success strengthens belief in personal predictive power, and that belief drives larger, riskier decisions. The expert trap. The more specialized the knowledge, the stronger the trap. Professionals operate in environments where expertise defines identity. Fund managers must appear decisive. Analysts must produce forecasts. Strategists must articulate views. Uncertainty does not sell, conviction does. But conviction in uncertain systems is statistically fragile. Experts are rewarded for appearing certain. Markets reward probabilistic humility. This misalignment creates the expert trap, the illusion of control. One of the most dangerous expressions of overconfidence is the illusion of control. Investors begin to believe they can time market cycles, predict macro events, anticipate central bank moves, detect inflection points. But markets are influenced by global behavioral feedback loops, policy unpredictability, technological shocks, geopolitical randomness, collective sentiment. No individual controls these forces. Yet intelligent investors often behave as though superior analysis reduces uncertainty. It does not. It clarifies possibilities, but uncertainty remains. Excessive trading, the overconfidence signature. One of the clearest behavioral markers of overconfidence is activity. Studies consistently show the more investors trade, the lower their long-term returns. Why? Because overconfident investors believe they can identify mispricings quickly, they can exit before downturns, they can re-enter at better levels, they can outperform passive exposure. Each trade increases transaction costs, timing error risk, emotional volatility. Confidence fuels movement. Movement multiplies mistakes. Forecasting failure. Kahneman and his colleague Philip Tetlock studied expert forecasting in political and economic domains. The results were sobering. Experts were only marginally better than chance. And the more famous the expert, the less accurate their predictions often became. Why? Because visibility amplifies narrative consistency. Public experts must defend prior statements. Admitting uncertainty threatens authority. In finance, this leads to doubling down on wrong theses, ignoring contradictory data, protecting reputation over capital. The expert trap punishes adaptability. The ego factor. Overconfidence is deeply connected to ego. Intelligent individuals often anchor identity to being right. Markets, however, do not reward being right occasionally. They reward survival consistently. An investor who insists on intellectual dominance may refuse to cut losses, add to losing positions, resist updating beliefs, because changing one's mind feels like defeat. But in probabilistic environments, updating beliefs is strength, not weakness. Ego converts flexibility into rigidity. Rigidity amplifies loss. Confirmation bias in experts. We all seek confirming evidence, but experts are better at finding it. They have access to more data. They can interpret signals more creatively. They can reinterpret disconfirming information. This creates a dangerous cycle. Initial belief to selective evidence to increased confidence to stronger belief. The smarter the mind, the more convincing the internal narrative. But internal coherence does not guarantee external validity. Markets punish narratives that ignore statistical reality. The asymmetry of information versus uncertainty. Experts often mistake information accumulation for risk reduction. But more information does not eliminate uncertainty. It can create information overload. And overload often leads to analysis, paralysis, narrative simplification, overfitting models to past data. Overfitting is a hidden form of overconfidence. A model that perfectly explains the past often fails in the future. But the more elegant the model, the stronger the attachment. Reputation risk versus financial risk. Professionals face a hidden constraint. Reputation risk. Being wrong unconventionally is career-threatening. Being wrong conventionally is survivable. This encourages consensus thinking. Ironically, consensus reduces outperformance. The expert trap pressures intelligent individuals to align with prevailing narratives. Contrarian thinking requires both analytical courage and psychological independence. Intelligence alone does not provide that. The defensive analyst. When positions move against them, overconfident investors often increase research intensity. They read more, model more, argue more. But often, this is not objective reassessment. It is defensive reasoning. System 2 becomes a lawyer for System 1's intuition. The investor believes he is thinking more carefully. In reality, he is thinking more selectively. The survivorship illusion. We observe successful investors and attribute their outcomes to skill. But we rarely observe those who failed using similar strategies. Overconfidence feeds on visible winners. The invisible failures distort perception. Intelligent investors may overestimate their odds because they see survivorship stories more than statistical distribution. This is a cognitive distortion, not a rational calculation. The humility edge. If overconfidence is the expert trap, humility is the escape. Humility does not mean passivity. It means accepting uncertainty, reducing position sizing relative to conviction, diversifying exposure, using checklists, seeking disconfirming evidence. The best investors are not the most certain. They are the most probabilistically aware. They recognize that complexity limits prediction. The core realization. Overconfidence is not a flaw of ignorance. It is a byproduct of intelligence without probabilistic discipline. The very tools that allow deep analysis can create deeper illusion. The more you know, the easier it becomes to believe you know enough. But markets are indifferent to intellectual elegance. They respond only to risk exposure over time. Closing reflection. The expert trap teaches a sobering lesson. Being smart is not a competitive advantage if you cannot regulate certainty. The investor who doubts intelligently outperforms the one who believes passionately. In the next section, we will examine how emotional asymmetry, particularly loss aversion, distorts even the most analytical minds. Because overconfidence inflates conviction, but fear reshapes behavior. And together, they define the cycle of financial error. Section 4. Loss aversion, and emotional asymmetry. If overconfidence inflates conviction, loss aversion distorts reaction. Daniel Kahneman's research, developed alongside Amos Tversky, revealed one of the most powerful asymmetries in human psychology. Losses hurt approximately twice as much as equivalent gains feel good. This is not metaphorical. It is measurable. The emotional system assigns disproportionate weight to negative outcomes. In financial markets, where gains and losses are constant, this asymmetry becomes decisive. And intelligence does not neutralize it. It often rationalizes it. The emotional weight of loss. Imagine two scenarios. You gain $10,000. You lose $10,000. Objectively, the magnitude is equal. Emotionally, it is not. The pain of loss is sharper, more urgent, more memorable. Loss activates threat circuitry in the brain. It feels personal. It feels immediate. It feels intolerable. This is not weakness. It is evolutionary wiring. Our ancestors who reacted strongly to threats survived. But markets are not predators, and the emotional intensity attached to financial loss can produce irrational action. Why loss aversion distorts investing. Loss aversion influences behavior in predictable ways. Investors hold losing positions too long. Investors sell winning positions too quickly. Investors avoid markets after downturns. Investors reduce exposure during volatility. Each reaction feels emotionally protective, but statistically, many of these reactions reduce long-term returns. The problem is not fear itself. The problem is timing. System 1 reacts immediately. System 2 calculates slowly. Fear wins the race. The disposition effect. One of the clearest expressions of loss aversion in finance is the disposition effect. Investors tend to sell winners early to lock in gains. Hold losers longer to avoid realizing losses. Why? Because realizing a loss transforms potential pain into actual pain. As long as a losing position is not sold, the loss remains unrealized. This creates a psychological loophole. The investor delays emotional discomfort, but markets do not care about psychological comfort. Holding deteriorating assets out of emotional avoidance compounds damage. Intelligent investors understand this bias intellectually, yet many still fall prey to it. The asymmetry of attention. Losses attract more cognitive attention than gains. A portfolio decline captures focus. A portfolio gain feels normal. This imbalance leads to hyper-monitoring during downturns, overreaction to short-term volatility, emotional decision-making. Frequent portfolio checking amplifies perceived risk. Daily fluctuations create emotional turbulence. The brain interprets volatility as threat, and threat triggers action, even when inaction would be statistically superior. Loss aversion and risk avoidance. After experiencing losses, investors often become excessively risk-averse. They shift to cash. They reduce exposure. They seek safety. But markets often rebound unpredictably, and missing early recovery phases significantly impacts long-term compounding. Loss aversion does not only affect individual trades, it reshapes overall asset allocation. It can turn temporary fear into permanent underexposure. The cost of emotional withdrawal compounds silently. Why smart investors are not immune. One might assume that intelligent investors, aware of this bias, would override it. But emotional asymmetry operates below conscious reasoning. Knowledge does not deactivate pain. It contextualizes it. In fact, intelligent investors may overanalyze losses. They search for deeper explanations. They build narratives around decline. They justify defensive positioning. System 2 becomes a sophisticated storyteller for System 1's fear. Awareness without structural safeguards is insufficient. The framing effect. Loss aversion is heavily influenced by framing. Consider two descriptions. Option A. You have a 90% chance of keeping your capital. Option B. You have a 10% chance of losing your capital. Statistically identical. Emotionally different. The second framing activates fear more strongly. Markets are framed constantly. Market wipes out billions. Investors lose trillions. The language of loss intensifies emotional response. Smart investors may recognize the framing bias, but emotional activation occurs before rational correction. Short-term versus long-term framing. One powerful mitigation technique involves time framing. Short-term declines feel catastrophic. Long-term historical charts show normal volatility. When investors zoom out, emotional asymmetry weakens. When they zoom in, it strengthens. Loss aversion is amplified by narrow framing. If you evaluate performance daily, losses dominate perception. If you evaluate performance over decades, volatility becomes background noise. The problem is not volatility itself. It is how frequently and narrowly we measure it. The pain of regret. Loss aversion is closely linked to regret avoidance. Investors fear making decisions they will regret. Selling at a loss feels like failure. Buying before a drop feels humiliating. Regret is a powerful emotional force. To avoid it, investors delay decisions, avoid rebalancing, refuse to realize losses, hesitate to enter markets. Ironically, attempts to avoid regret often create larger regret later. Avoiding small losses can lead to catastrophic ones. Emotional memory may. Losses are remembered more vividly than gains. The emotional imprint of a crash can persist for years. This creates long-lasting behavioral distortion. Investors who experience major downturns early in life often remain permanently risk-averse. Experience shapes perception. Perception shapes allocation. Allocation shapes wealth trajectory. Intelligence does not erase emotional memory. It merely explains it. Loss aversion and market cycles. Loss aversion contributes to cyclical extremes. During bull markets, gains reduce perceived risk. Investors increase exposure. During bear markets, losses intensify fear. Investors reduce exposure. This creates pro-cyclical behavior. Buy high, sell low. The exact opposite of optimal strategy. Markets are not just economic systems, they are emotional feedback loops. Loss aversion fuels volatility at scale. The structural solution. Kahneman did not propose eliminating loss aversion. That is impossible. Instead, the solution lies in architecture. Mechanisms that reduce emotional reaction. Automatic rebalancing. Predetermined allocation bands. Position sizing limits. Reduced portfolio checking frequency. Long-term framing. Structure compensates for asymmetry, because asymmetry cannot be erased. The hidden advantage of acceptance. One of the most powerful insights for investors is this: loss is unavoidable. Temporary decline is not failure. It is structural to market participation. When loss is reframed as volatility rather than catastrophe, emotional asymmetry weakens. Acceptance reduces reaction. Reaction reduces error. Error reduction compounds wealth. The core lesson. Loss aversion is not a flaw. It is a survival mechanism misapplied to abstract systems. Markets are not predators, but they trigger predator response circuitry. Intelligence does not silence fear. It may even amplify it through analysis. The investor who understands loss aversion must go beyond awareness. He must design around it, because emotional asymmetry, left unchecked, can destroy decades of compounding. In the next section, we explore another invisible distortion: the narrative fallacy. Why smart people prefer coherent stories over statistical truth, and how this preference quietly undermines investment judgment. Because fear distorts reaction, but stories distort perception, and perception drives capital allocation. Section 5. Narrative fallacy and market storytelling. Human beings do not think in probabilities. We think in stories. Daniel Kahneman identified this as one of the most subtle and most dangerous distortions in judgment. The narrative fallacy. When confronted with randomness, complexity, or uncertainty, the human mind constructs coherent explanations. We crave causality. We crave clarity. We crave stories that make events feel predictable. Markets, however, are complex adaptive systems. They do not unfold like novels. Yet investors constantly attempt to turn volatility into narrative. And intelligent investors are particularly skilled at it. The need for coherence. Uncertainty is uncomfortable. Randomness is unsettling. A story restores psychological order. When markets rise, we hear, growth expectations improved. When markets fall, we hear, geopolitical tensions increased. The explanation arrives instantly, but often the explanation is post hoc. The market moved first. The story came later. System 1 demands meaning. System 2 constructs it. The result feels like understanding. But it is often illusion, the illusion of causality. In financial media, every movement requires a cause. Yet short-term price fluctuations often reflect liquidity imbalances, algorithmic flows, sentiment shifts, random clustering. But randomness is not satisfying, so we impose causality. Smart investors, equipped with knowledge, can build highly sophisticated explanations for market behavior. But sophistication does not equal predictive power. Coherence is not correlation. Correlation is not causation. And causation is often unknowable in real time. Storytelling and overconfidence. Narratives do more than explain. They reinforce conviction. If you believe, this company is transforming the industry, you will interpret new information through that lens. If you believe, this macro regime guarantees recession, you will filter data accordingly. Stories anchor expectations. Expectations shape allocation. Allocation determines risk exposure. Once a narrative takes hold, contradictory evidence becomes inconvenient. The intelligent mind then shifts from analysis to defense. The media amplification effect. Financial media operates on engagement. Engagement thrives on clarity. Clear villains, clear heroes, clear causes, clear forecasts. But markets are rarely clear, so the narrative must simplify. Complex reality becomes digestible storytelling, and repeated storytelling shapes collective belief. Investors absorb these narratives daily. Even if intellectually skeptical, repetition increases familiarity. Familiarity increases perceived truth. This is the fluency effect in action. The more you hear a story, the more plausible it feels. The hindsight illusion. One of the most powerful narrative distortions is hindsight bias. After events occur, they feel inevitable. We look back at crashes and say, the warning signs were obvious. We look back at bubbles and say, it was clearly unsustainable. But before the event, uncertainty dominated. Hindsight creates false confidence in predictive ability. It convinces investors they should have known. This fuels future overconfidence. The narrative of inevitability masks the original randomness. The planning fallacy in markets. Investors often build long-term theses around coherent macro narratives. Demographics, technology cycles, monetary regimes. These narratives feel robust, but forecasting complex systems over extended time horizons is inherently fragile. Narratives compress uncertainty into direction. They reduce probabilistic range into linear projection. The future rarely unfolds linearly. Yet narrative thinking favors linear progression. And linear thinking underestimates volatility. Identity and story attachment. Narratives become identity anchors. An investor may see himself as a value investor, a growth believer, a macro strategist, a contrarian. These identities are tied to stories about markets. Once identity fuses with narrative, detachment becomes difficult. Updating a view feels like betraying oneself. The market does not punish identity. It punishes rigidity. The smarter the investor, the more elegant the narrative. The more elegant the narrative, the harder it is to abandon. The story. Premium. Markets often price narrative more than fundamentals in the short term. Compelling stories attract capital. Capital drives prices. Price movement reinforces the story. This feedback loop can detach valuation from reality. Intelligent investors may recognize overvaluation, but narratives can persist longer than expected. Timing the collapse of a story is extraordinarily difficult. Understanding narrative power does not grant immunity from its influence. The data versus story conflict. Statistical thinking requires abstraction. It requires accepting probabilities, base rates, variance, nonlinearity. Stories, in contrast, are concrete. They feel intuitive. A charismatic founder is easier to evaluate emotionally than discounted cash flow assumptions. A geopolitical storyline is easier to grasp than stochastic modeling. System 1 prefers stories. System 2 requires effort. Under stress or overload, the mind defaults to narrative. The danger of simplification. Markets are multi-causal systems. Interest rates, credit cycles, liquidity, behavioral feedback, technological shifts. Narratives simplify complexity into a single dominant cause. This simplification feels satisfying, but simplification removes nuance, and nuance often determines risk. The investor who believes this market is rising because of AI may ignore credit conditions. The investor who believes this decline is purely political may ignore structural imbalances. Narratives narrow focus. Narrow focus increases blind spots. The comfort of explanation. Perhaps the most subtle danger of narrative fallacy is emotional comfort. Explanation reduces anxiety. Even a wrong explanation feels better than uncertainty. The mind prefers confident error to ambiguous truth. Smart investors accustomed to analytical clarity may feel compelled to resolve ambiguity quickly. But in markets, ambiguity is permanent. Trying to eliminate it through storytelling creates false security. Breaking the narrative trap. Kahneman did not argue that narratives are useless. He argued they must be treated with suspicion. Strategies to reduce narrative distortion. Separate story from probability. Ask, what is the base rate? Consider alternative explanations. Write down pre-commitment rules. Focus on valuation rather than narrative excitement. Measure outcomes statistically, not emotionally. Narratives should inform hypotheses. They should not replace statistical discipline. The deep paradox. The paradox is this: stories drive markets, but believing the story too strongly destroys investors. Narratives move capital, but attachment to narrative increases risk. The sophisticated investor must operate within stories while remaining psychologically detached from them. That requires discipline and humility. Closing reflection. The narrative fallacy explains why smart investors construct elegant theses that later unravel. It explains why bubbles feel rational. It explains why hindsight feels predictive. Markets do not owe coherence. They owe no story. They are probabilistic systems governed by uncertainty. The investor who replaces story with structure reduces illusion. The investor who clings to narrative amplifies vulnerability. In the next section, we explore the planning fallacy and forecasting failure. Why even experts consistently misjudge the future, and what that means for capital allocation. Because stories shape belief, but forecasts shape risk, and both are fragile. Section 6. The planning fallacy and forecasting failure. If narrative fallacy distorts how we explain the past, the planning fallacy distorts how we imagine the future. Daniel Kahneman identified the planning fallacy as one of the most persistent cognitive errors in human decision-making. We systematically underestimate time, cost, and uncertainty, even when we know better. This bias does not disappear with intelligence. It becomes more sophisticated. In investing, it manifests as forecasting confidence. We believe we can anticipate economic cycles, market turning points, corporate earnings, trajectories, political outcomes, interest rate movements. And yet, forecasting in complex systems is notoriously unreliable. The future does not unfold linearly, but the human mind predicts linearly. The planning fallacy defined. The planning fallacy occurs when individuals underestimate risks, overestimate benefits, ignore historical base rates, assume smooth execution. It is rooted in internal focus. Instead of asking, what usually happens in situations like this? We ask, what do I think will happen in this situation? The first question relies on statistical history. The second relies on imagination. Investors overwhelmingly prefer imagination, inside view versus outside view. Kahneman distinguished between two perspectives. Inside view focused on specific details of the current case, driven by scenario building and narrative. Outside view, based on historical data from similar situations, anchored in base rates and statistical distribution. The inside view dominates because it feels intelligent. It engages analysis. It builds tailored reasoning. The outside view feels reductive, but it is statistically superior. Investors often rely on inside views when forecasting markets. They construct detailed scenarios. They analyze macro variables. They develop multi-step projections. Yet history shows forecasting accuracy remains low. The illusion of foresight. After events occur, they appear predictable. This is hindsight bias layered onto forecasting failure. When a recession hits, analysts point to indicators that clearly signaled risk. When a rally emerges, commentators identify catalysts that obviously led to growth. But before the outcome, probability was distributed across multiple paths. The illusion of foresight convinces investors that prediction is easier than it is. That illusion fuels overconfidence. And overconfidence increases risk-taking. The forecasting industry problem. Entire industries revolve around prediction. Economic forecasts, market outlook reports, quarterly guidance, strategic outlook presentations. Prediction sells. Uncertainty does not. Investors consume forecasts constantly, but research shows that professional forecasters rarely outperform naive statistical models, frequently revise predictions, display high confidence despite low accuracy. The more complex the system, the less reliable the forecast. Markets are among the most complex systems on Earth, yet forecasting remains central to financial behavior. Why smart people forecast more. Intelligent individuals are trained to solve problems. They believe analysis reduces uncertainty, and in many domains, it does. Engineering, medicine, mathematics. But markets are adaptive systems. Each forecast influences behavior. Behavior alters outcomes. Outcomes invalidate forecasts. This reflexivity undermines predictive stability. The smarter the investor, the more intricate the forecast. The more intricate the forecast, the more fragile it becomes. The seduction of specificity. Specific predictions feel impressive. Markets will decline 15% by Q3. Interest rates will peak at 4.75%. Inflation will normalize within 18 months. Precision increases perceived credibility, but precision does not increase accuracy. In fact, specific forecasts are often less accurate than probabilistic ranges. The brain prefers specificity. Probability ranges feel unsatisfying, but markets reward probabilistic thinking, overfitting the past. Forecasting often relies on historical pattern recognition, but patterns in markets are not permanent laws. Overfitting occurs when a model explains past data perfectly but fails to generalize. Intelligent investors are especially vulnerable. They can detect complex correlations. They can model relationships elegantly, but past correlations do not guarantee future persistence. Markets evolve. Participants adapt. Conditions shift. The more precise the model, the more fragile it may be. The cost of prediction. Forecast-driven investing introduces structural risks. Timing errors, missed compounding, excessive repositioning, emotional volatility. When investors attempt to predict recessions, they often exit too early. When they attempt to predict rallies, they often enter too late. Prediction invites action. Action increases friction. Friction reduces returns. The paradox is stark. The desire to avoid uncertainty often increases exposure to error. Why we cannot stop forecasting. Prediction offers psychological comfort. It creates a sense of control. Uncertainty feels intolerable. Even incorrect forecasts feel better than admitting ignorance. Smart investors often feel compelled to form views, because having no opinion appears weak. But markets do not reward opinion. They reward exposure management. The structural alternative. If forecasting is unreliable, what remains? Architecture. Instead of predicting cycles, design portfolios that survive cycles. Instead of timing volatility, structure allocation bands. Instead of reacting to macro shifts, diversify across regimes. This is not passive ignorance. It is active acceptance of uncertainty. The outside view suggests markets trend upward over long horizons. Volatility is normal. Crises are inevitable. Recovery is frequent, but unpredictable in timing. Planning based on these base rates is statistically stronger than attempting detailed prediction. Humility as competitive advantage. Kahneman's work suggests that humility is not weakness, it is realism. Recognizing forecasting limits leads to lower turnover, broader diversification, longer time horizons, reduced emotional reactivity. The investor who acknowledges uncertainty is less likely to overcommit to fragile theses. Forecasting confidence creates fragility. Probabilistic humility creates resilience. The deep lesson. The planning fallacy reveals something fundamental. We are wired to underestimate complexity. Markets are complex. Therefore, we are wired to misjudge them. Intelligence does not eliminate this bias. It increases the sophistication of the forecast. But sophistication does not equal reliability. The question shifts from what will happen to how do I prepare for multiple possible outcomes? Preparation outperforms prediction. Closing reflection. Forecasting failure is not a sign of incompetence. It is a structural feature of uncertainty. The most dangerous investor is not the uninformed one. It is the intelligent forecaster who mistakes confidence for accuracy. Kahneman's insight is clear. The future is uncertain. Your mind will underestimate that uncertainty. And if you act on that underestimation repeatedly, the cost compounds. In the final section, we will explore how to build a bias-resistant investor, not by eliminating intelligence, but by structuring it. Because you cannot remove bias, but you can design around it. And design, not prediction, determines survival. Section 7. Building a bias-resistant investor. If intelligence does not protect you, if overconfidence amplifies error, if loss aversion distorts reaction, if narratives reshape perception, if forecasting fails, then what remains? Structure. Daniel Kahneman did not argue that bias can be eliminated. It cannot. Bias is not a glitch in the system. It is the system. The goal, therefore, is not perfection. It is resistance. A bias-resistant investor is not bias-free. He is architecturally protected. Step 1. Accept cognitive limits. The first step toward bias resistance is humility, not performative humility. Statistical humility. Accept that you cannot predict market turning points consistently. You are prone to overconfidence. You feel losses more intensely than gains. You prefer stories over probabilities. You underestimate uncertainty. This acceptance is not pessimism, it is calibration. Without calibration, intelligence becomes dangerous. With calibration, intelligence becomes useful. Step 2. Replace prediction with probabilities. Instead of asking, "What will happen?" ask, "What are the plausible ranges of outcomes?" Bias-resistant investors think in distributions, not points. They do not commit fully to one scenario. They size exposure relative to uncertainty. They assume they might be wrong. Timing might fail. Volatility will occur. This mindset reduces fragility. Overconfidence shrinks. flexibility increases. Step 3. Use pre-commitment rules. Emotion dominates in the moment. Structure must dominate before the moment. Pre-commitment mechanisms include fixed asset allocation targets, rebalancing thresholds, maximum position sizing rules, stop-loss policies, when appropriate, capital allocation caps. Rules decided calmly prevent impulsive reaction under stress. System 2 designs the rule. System 1 cannot override it easily. This is architectural defense. Step 4. Slow down decisions. Speed favors. System 1. Deliberation activates System 2. Bias-resistant investors insert friction intentionally. Mandatory waiting periods before large trades. Written investment theses. Probability scoring before action. Counter-argument exercises. Asking, "What would make me wrong?" is one of the most powerful bias filters. The goal is not to eliminate intuition. It is to test it. Step 5. Diversify against yourself. Diversification is not only about assets, it is about psychology. You diversify because you cannot forecast perfectly. You cannot identify every risk. You cannot eliminate error. Diversification acknowledges ignorance. Overconfident investors concentrate. Bias-resistant investors distribute, not because they lack conviction, but because they respect uncertainty. Step 6. Reduce exposure to noise. Noise amplifies bias. Constant market updates trigger emotional reactivity. Frequent checking increases perceived volatility. Perceived volatility increases stress. Stress strengthens System 1. Bias-resistant investors. Limit news intake. Reduce portfolio monitoring frequency. Avoid reactive environments. Focus on long-term metrics. Silence stabilizes cognition. Stability improves judgment. Step 7. Separate identity from outcomes. One of the most dangerous traps in investing is identity fusion. I am a growth investor. I am a macro strategist. I am contrarian. When identity merges with strategy, flexibility disappears. Bias-resistant investors separate ego from allocation. Changing position does not threaten identity. Updating belief is not weakness. It is adaptation. Markets punish rigidity. They reward resilience. Step 8. Embrace base rates. The outside view must dominate. Historical data shows markets experience regular drawdowns. Crashes are normal. Long-term upward drift exists. Timing recoveries is nearly impossible. Bias-resistant investors build strategies around these base rates. They assume volatility. They expect discomfort. They do not interpret decline as anomaly. When decline is anticipated, reaction is reduced. Step 9. Design for emotional durability. The best strategy is useless if it cannot be emotionally tolerated. A portfolio that causes panic will be abandoned. Bias resistance requires allocation. You can hold through downturns. Risk level aligned with psychological tolerance. Cash buffers for stability. position sizing that reduces fear. Emotional durability ensures continuity. Continuity ensures compounding. Compounding ensures wealth. Step 10. Institutionalize self-doubt. Self-doubt must be systematic, not sporadic. This includes reviewing past decisions objectively, tracking forecast accuracy, quantifying error frequency, writing decision journals. Many investors remember successes and forget mistakes. Documentation disrupts illusion. Reality corrects narrative. Feedback improves calibration. The meta-insight. Bias resistance is not about becoming hyper-analytical. It is about reducing exposure to predictable human error. You do not need to outsmart the market. You need to avoid sabotaging yourself. The intelligent investor who lacks structure is fragile. The moderately intelligent investor with structure is durable. Durability compounds. Fragility collapses. The true edge. Markets are competitive. Information diffuses quickly. Analytical advantage decays. But behavioral discipline remains scarce. The true edge is not superior forecasting. It is superior self-regulation. Self-regulation is not emotional suppression. It is structural design. Closing reflection. Daniel Kahneman revealed a truth that reshapes investing. Your mind is not built for probabilistic financial systems. It evolved for survival. It reacts quickly. It seeks patterns. It defends belief. It fears loss. Intelligence does not override these instincts. It often empowers them. The bias-resistant investor does not fight the mind. He designs around it. He accepts uncertainty. He diversifies against ego. He limits noise. He slows decisions. He commits before emotion. He builds durability over brilliance. Because in markets, brilliance is episodic. Durability is exponential. And exponential growth belongs to those who survive their own psychology.